But what do you make of the market action so far? Where's your head?
So my head is the market is still thrashing around with, oh my God, look at the inflation numbers, versus some underlying changes going on. So there's rotations going on, which makes everything feel super choppy. Every bear is shouting, oh my God, the Fed are going to raise rates, everything's going to crash. There's the deflationists, who I would count myself into that camp, saying, well, the world won't take higher rates, and if you raise the rate of inflation higher, faster than the wages, you're going to see consumption fall. So there's this battle going on in the markets right now and in narratives, and obviously the inflation narrative has taken hold, but I'm starting to see forward-looking indicators suggesting that it's not going to stick. And that's contentious in itself. So everyone wants to throw poo at each other over Twitter, even suggesting that's happening. But that's the world we live in.
It's so true. This is a time when there's very little consensus. It's confusing for people.
Yes, it is. And that's usually what happens when you're at the end of a particular market regime. So, you're starting to see the two different narratives fighting for control. And it feels like that's the situation we're in. Doesn't mean it happens overnight. I think market volatility is the outcome for a while longer, until people get comfortable with, okay, what is happening? Now, it's pretty straightforward to me, is if the bond market, if we look at the yield curve, it's flattening. If that breaks those recent lows, it's telling us the Fed cannot raise significantly more, or even the 4 times that they're talking about. So then we will start to see the 10-year bond yields peaking out. That would be at the top of that long-term trend, the chart of truth, as I call it, which is the 30-year channel of bond yields. About 2% is the top of that channel. Sometimes at the peak of cycle, it goes to a little bit through, 25 basis points through. So somewhere around then, you'd start to see the reversion. We're starting to see the ISM new orders, the ECRI. We're starting to see retail sales today. All sorts of indicators saying the Atlanta Fed came in and revised down growth this morning in their Fed Now model. So I think that's the macro shift that's underway. And we've seen it as commodities stopped going up, really. Some commodities have rebounded, but it's been less clear. The inflation trade is less clear in the markets any longer, and we've got this value growth rotation. The kind of core kind of tech, super long names are still getting smashed, but as soon as the bond market turns around, they'll turn around too.
So this is really important, and this is why you watch the bond market, because you think that that's leading, right? Some of what we're seeing in this rotation is maybe paying more attention, or is the tail, paying more attention to some of the lagging.
So if you're a bond trader, your entire job is to analyze inflation and GDP growth. That's it. If you're an equity trader, you're trading sentiments, you're trading earnings, you're trading buybacks, you're trading all sorts of things. Bond traders do 2 things: inflation, GDP growth, which is why they tend to be right, because that's what they get paid to do, is look at 2 things only. So over time, very rare the bond market's wrong. 1994 was the only time in my entire career the bond market's been really wrong about things. So I always pay attention to the bond market, because I call it, the bond market is the truth.
The inflation debate is very interesting, isn't it? And I have to say, we are so fortunate to have so many sort of really smart minds, market watchers, a lot of experienced guests coming through the programs on Real Vision. And you've noticed a lot of them sort of saying what you're saying, that I think it's peaking. I think inflation's peaking. What about the other side of that argument when people say, look at wages and look at things like housing and rent? Those are, you lock in for the year, and that isn't even started to hit the inflation print.
They're all lagged, for starters, because it's the slowest, hardest thing to do. Secondly, look at wage inflation and think, is net incremental demand in the economy going up? Well, wage inflation is less than inflation, so we've got negative real wages. Secondly, there are more people leaving the labor force than ever before. The labor force participation rate is super low. Many of those are baby boomers who have high incomes and high earning power. So you're offsetting millennials, giving them an increase. They earn a lot less than they are leaving. So net, you've probably got a fall in total demand. And you're seeing it in the numbers already, I believe, which was the retail sales numbers that came. Partly it's Omicron, it's not clear yet. But my view is that we're actually lowering the trend rate of growth, but people can't see it because we're still dealing with the machinations after the pandemic.
Yeah. What do you think this means for the Fed then?
So my view, and it has been all year, and I've been looking at this whole junction all year because I think it's the bigger trade, is I think the Fed are not going to deliver what they say. I looked at every recession going back to 1963, and almost every single time there is a growth scare early on because the economy's not fully stabilized yet. So what happens is stimulus comes out of the economy, fiscal stimulus. The Fed start talking about tightening because inflation's risen, because the year-on-year rate of change and stuff like that. This time we've got supply issues. And then what happens is the Fed think about raising, and before you know it, growth evaporates again. And then the Fed actually end up cutting. So I think we will get a couple of rate rises in, potentially, maybe only one. That's my view.
One.
Well, because I think by June, I think inflation's back down to 3%, and the ISM is probably closer to 52 than it is to 60. So you don't want to tighten into a falling economy going into an election. I know the narrative now is, well, they need to tighten to look like they're fighting inflation. Best thing to do is talk tough, get a rate hike in, maybe two 25 basis points in, then let the natural kind of ebbing and flowing of the economy work in your favor. You can say, we've beaten inflation, and then you can get a stimulus package through.
Yeah, take a victory lap that we telephoned to before we had to actually do.
And then stimulate ahead of the election. I mean, that would be perfect for them.
So the reason my jaw dropped, obviously, we've all seen the headlines, right? You have the market pricing in at least 4, not only interest rate hikes, but lots of talk about quantitative tightening. This is aggressive.
Yeah. So here's the fact is, I saw it yesterday, and I've been following this for 2 decades now. Every single year of my entire career, every single investment bank has predicted rates too high. Without question. 100% forecast error. And they do it all the time because they seem to ignore the fact that we're in a secular downtrend driven by demographics with a massive credit bubble. So you can't raise rates. I mean, you can't generate inflation and you can't raise rates. But they ignore it every time. And every time, I remember last time we hit the chart of truth line, which was back in 2018. The last time I was starting to comment about, I think this dynamic's changing. Jeff Gundlach's like, it's breaking the chart of truth. It's going to 6%. The world's going to fall apart. I've heard this every 3 years of my career. And it never happens. Now, is this time different? There's always a probability, but it's not the highest probability to me.
So Robert, who put a question into the RV site, that answered his question. Are they going to raise rate 4 times? Is this even possible without cratering the economy? Rob just answered that. We do have, so what does this mean for risk assets? We do have people asking about, what about this, sell-off we've seen in tech? Given that outlook, that you don't expect that action from the Fed, does this sort of give you any indication of how risk assets? So what makes
long duration assets less attractive is not increasing bond yields, it's the inflation that we've had. So you discount it by the inflation. So if the market is wrong in expecting higher inflation for longer, then growth stocks will explode higher again. Because really, let's face it, we live in an exponential age. Anybody who thinks that tech stocks, high growth, long duration tech stocks that are capturing exponential rise of technology are not going to go up again, that can't happen just because of network effects of what's going on. We're not talking about IBM here or GE stock, or some of these things can trade sideways for decades, but you can't trade sideways for decades when you've got exponential growth going on. It just can't happen. Now, you can have periods of a year, 18 months of sideways down markets, which we've been seeing. But then what happens is they end up looking ludicrously cheap versus what's happening. And the moment the inflation story disappears, then everyone piles into growth again.
So that leads us, Eric asking a second part of his question from the exchange. What about crypto?
Crypto is similar to growth. It's driven by its own network models and adoption. There's a bunch of other stuff. But similar to that, I said crypto have been trading sideways because wage growth has not kept up with inflation. So marginal dollars to invest by retail has been reduced. And I think that it gets partly caught up in the growth story, but there's no correlation really between bonds and crypto, the dollar and crypto. They're all passing correlations that come in and out. Suddenly the S&P is correlated for a bit and then it's not. So I don't worry about that. I just look at the network effects over time. But if the Fed increase the size of the balance sheet, then it's all correlated because you're lowering the value of the denominator. So that's why when the Fed increase the balance sheet, what you find is that everything goes up. Now, does it happen when the Fed decrease the balance sheet? Are they going to shrink the balance sheet? And does that crash the markets? If they do it, markets will stop going up as much because of the fact that you're increasing the value of the denominator. So it changes that. So yes, we saw it last time around. There was a period of time as the Fed were reducing the size of the balance sheet. No, they kept the balance sheet stable. Stocks were sideways for a while. But then even with a stable balance sheet, stocks took off again because the growth story is still underlying. What the market won't like is raising rates. It took 8 times before the market cracked last time. So it never happens on the first couple of goes. The market has a wobble, but then it shakes it off. So it took 8 times last time, and it took the balance sheet taper. And then the market started rolling over.
So you feel like sideways. You and Julian Bridgen of MIT had just filmed your latest Macro Insider conversation, and Julian seemed a lot more concerned about the risks around that change. So
Julian's from the silver market. His modus operandi, everything in his body is about inflation and the Fed are going to take your precious metals away. So, and then to be fair, he nailed the inflation call this year. I was more sanguine. I didn't really get involved, but he really saw it coming. So we have that argument because I'm a dyed-in-the-wool deflationist. he's a dyed-in-the-wool inflationist.
Well, that's why the conversations are so good, and you were very kind to him, entertaining his concerns about that. But
I can't see the issue I have with this is, okay, so we've got inflation. What happens? You raise rates. What happens? Markets eventually slow down. The economy slows down. Eventually, the stock market goes down, and eventually, the Fed come back in because they can't allow the collateral of the market, the equity market, the bond market, whatever, to fall apart. So then they stimulate again. So I'm like, well, it's kind of a never-ending cycle of, even if it comes off, it stimulates. So I'm not worried by it, really, I guess.
And you're not worried that inflation stays high enough that it prevents them from sort of looking after the asset market. Some people think they want to take steam out of the asset markets.
I don't think they do. I think, look, that's the risk to my view, is that I'm wrong. And growth itself, let's say later back end of 2022, is stronger than I expect, and inflation persists at 3.5%, 4%. That I would be wrong. And if that was the case, then we're going to see a more prolonged bear market in these higher growth tech names. Bond yields, I don't think bond yields would move a lot on that, but we get more of this market rotation in the equity market, stuff like that.
We have a question from JB on the exchange. Since we're talking about the potential for all of the tech stocks once again to take off, what's your opinion of ARK and Cathie Wood?
So it staggers me that people get emotional about somebody else's portfolio. And people get emotional about Cathie Wood. They don't like it. Why? Because it's all about change. It's all about non-traditional valuation metrics using things like Metcalfe's law. They don't like it. I really respect Cathie's view. And yes, she's dealing with this massive rotation out of the names that she owns. It's normal. I have a log chart. I have an ARK that I look at all the time, a monthly log chart. It's about 2 standard deviations oversold in the trend channel. Most likely, we're at the lower end of the range. $70 is 2 standard deviations. We hit 78 today. Does it break it? False break? Go higher? Probably. So I am getting very interested in accumulating. I've been talking about this trade for a long time, been waiting for this to set up, letting the inflation narrative get bigger and bigger and bigger, let people throw the baby out with the bathwater, which is the network growth stocks that you absolutely want to own for the next 10 years. We're getting an incredible entry point, I think. Now, I understand people think there's technical difficulties because she ends up selling liquid stocks to fund the illiquid stocks. I get that. Let's see how it plays out. I get there's a risk. That's okay. Markets have risks. And we're all adults and we decide what risk we'll take and what risk we won't take. I'll probably take that risk.
Entry point is really important, isn't it? Because, we've seen a lot of concern and a lot of angst over the decline we saw in crypto from the November highs. So if you bought at that time, it's been incredibly painful and stressful for people. But in your note, in your GMI note to your investors, your think piece in January, you kind of reminded everyone what the gains were in Bitcoin and ETH last year. I think it's worth reiterating that, right? It depends when you get in.
That's right. I mean, last year I had one of the best years I've ever had, and Ethereum, which was my biggest bet, was up 450%. And Bitcoin was a smaller bet, and that was up 60%, and a whole bunch of stuff was up hundreds of percent. And that's not to boast about me. It was about sticking with the plan that I had, and I got the right timing to get in at the right time. So if you remember at the time, I'm a macro guy. I wait for the buses to turn up. I don't try and I don't try to find every trade. I'm not interested in that. I'm not a short-term guy. So I wait and wait and wait. And I waited for that crypto opportunity. I'd been saying for maybe 2 years, 3 years that crypto and macro are about to meet, and it's going to meet at the next recession. The Fed are going to have to print massively, and this is the time to buy. And I went all in. And I've been talking about the exponential age for an extended period of time now, saying, listen, this is the big trade. The big equity trade here is the exponential age, which are all of these network adoption models of modern technology. So here we are setting up exactly the right trade, which is stuff like ARK or Scottish Mortgage, all of these things. They're all coming for the entry point. You get the entry point right at the maximum point of fear when everybody says, this is terrible. That's the point you can drive extraordinary returns if you're a long-term holder. I'm not a trader, so I don't really care about the next 3 months. If I buy ARK, I'm expecting to hold it for 5 to 10 years. And if I get it right, it'll go up 10x. That's what I'm thinking.
If we flip back to crypto for a minute, how are you thinking about this now? And, talk to me about the other coins as well. Because if you got in November, very painful. If you saw gains like you experienced, we get a lot of questions. Should I continue? Should I hold? Should I take profits? Do I buy more? Do I buy this dip? How are you thinking about that space?
Everything comes down to time horizon. Firstly, don't put too much money in that you can't afford to ride the volatility. I've told everybody this for 2 years now. Expect 50% drawdowns as normal course of business and not calling it a bear market, just calling it a correction. So that's what you need to deal with. And everybody needs to make their own decision. It's also time horizon. If you think it goes up, 20, 30x over the next 5, 6, 10, whatever your number is, well, then a 50% drawdown is just small noise on the chart. If you're trading for a 3-month time horizon, it falls 50% on you. Well, you've got it dead wrong because your time horizon is different. So I am looking to add more to my positions into this kind of market because I don't think anything's changed. Nothing's changed in the network adoption. Network slowed down a bit for the reasons we talked about before. So over time, we see the institutions coming. I'm talking to them every day. I launched a crypto fund of funds. We've already put the first $100 million to work. That goes straight into the markets via the hedge funds. That ongoing allocation of assets is happening. So it doesn't stop. So it trades sideways for a year. That's great. It tends to mean periods of suppressed volatility lead to hyper volatility. Periods of hyper volatility tend to lead to periods of suppressed volatility. And we've basically had a sideways market where volatility has been falling since May.